So good morning to those of you that joined a few minutes late. As you can tell, we're using a little different platform this morning, trying something different to see how that works. I'm going to do a continuation of what we talked about last week. I'm going to cover this morning some of the common myths that I hear in the real estate game. All kinds of misconceptions out there, a lot of bad information flowing around. So this morning, I'm going to try to dispel a few of those myths. A few things that I've observed. I've been doing this for quite a while now. For those of you that don't know me and are new to Coffee with the Cash Flow Guys, my name is Tyler Sheff. I am the host of the Cash Flow Guys podcast. I'm a real estate investor. My primary focus is in apartment buildings. Over and above that, I am a licensed real estate agent in the state of Florida. So I help other people buy and sell investments, buy and sell properties and whatnot. I now manage a team of other agents that we're just rolling out the new team concept, getting some agents on board that are go-getters, wanting to make things happen, take their business to the next level, help other people get out of the rat race. That's my big thing, is I want to see people get out of the rat race. The rat race, for those of you that don't know, basically means that you get out of bed in the morning, you go to work, you do that 5-6 days a week, you pay your bills, you have very little time for yourself, very little time for your kids, and then you move on and start all over again the following Monday. So it's a constant rat race. You're like on a rat on a wheel, never get anywhere. I lived in that rat race for many, many years. I escaped several years ago, never looked back, and don't have any intention on getting back in. Although, full disclosure, I did get myself back into the rat race by not being responsible with how I was managing my money. And the difference there was financial intelligence. So I needed to become more financially intelligent. How I did that was a lot of self-study. Number one, I spent a ton of time reading different books, reading the series from Robert Kiyosaki, Rich Dad, Poor Dad, ABCs of Real Estate Investing, Cash Flow Quadrant. I can go on and on and on. I launched the podcast as a way to document my journey, number one, as far as taking my investing to the next level, and of course, helping people do the same. And I wanted to spread that information out to other people. Today, we're going to talk about common myths. That is, the myths that we hear in real estate. There's so much misinformation out there. I felt it's necessary to address some common points, some things that people tend to hear and then they go ahead and believe, and it either makes them give up on the whole idea of real estate investing, or it makes it that much more difficult. And realistically, nothing that we do is rocket science. Okay, we're not out there. This is not difficult. It's only as difficult as you make it. So that said, you'll see there's a Q&A at the bottom. Click the Q&A button. If you have questions, go ahead and type them in the Q&A box. If you want to come up on video or audio, you let me know and I can make you a panelist, which will bring your video and audio up to the screen. So we're going to give this format a shot. Give me some feedback at the end if this makes sense for you. If you absolutely hate it, well, speak up. Let me know that as well. Send me an email. And I'm going to go ahead and share screen here real quick, and we will get started. Okay. You guys should see my screen now. Now, this is going to be a continuation of last week where we talked about buying rentals 101. Made a couple changes to this since we did it before, but I want to talk about a couple different myths that, like I said, that we see in the industry and kind of get those things dispelled and knocked down a little bit for you. Again, my name is Tyler Sheff. I'm the host of the Cash Flow Guys podcast. Here are my social media links down at the bottom. If you want to reach out, you want to get on board with our social media, by all means, reach out. Myth number one, true or false, is where we'll start. Banks are my friend because they're not allowed to take advantage of me. I hear this quite often. It kind of shocks me that people still believe that banks are our friend, that they can't hurt us. We can do whatever we want because we don't have to worry because the bank won't hurt us. Foreclosures are safe because the banks are our friend. Well, that's false, ladies and gentlemen. That's false. You have to understand that banks are companies. Banking is a for-profit business, and they're often bailed out by the government. Now, even though they're a for-profit business, they consistently need government bailouts, and that makes me wonder, what are they doing? They're obviously not doing something right, or they wouldn't need to keep getting bailed out. The foreclosure process is a challenging one. Now, I've heard of a lot of people getting burnt buying foreclosures. Other people can make it very profitable, and it really depends on how strong your team is when you buy these. Now, these are not for the faint of heart. And the stories that you hear of people not, or maybe getting taken advantage of, or losing money in these transactions, well, part of the problem is their team. Either they don't have a team, or they're relying on a real estate agent that does not have experience with foreclosures. Banks are really not required to comply with any ethical standards, first of all. They're banks, they're companies. They can essentially do whatever they want. And here's the deal, and I've been told this by banks, by in the foreclosure departments, go ahead and sue us. There's nothing you can do to us. They've actually said that to me. They've said that to colleagues of mine. They get to do whatever they want. We can't do anything because we're the private party. What are you going to do? Sue the bank? Are you going to sue Wells Fargo or Bank of America or whoever wronged you? No, you're not going to get very far. So keep that in mind when you're doing business. Tread carefully. Make sure that you work with a team that knows what they're doing. Really good title company, maybe even a closing attorney, rock star agent that can get through these challenges. Understand that there's very few laws that govern proper contractual procedure in the disposal of foreclosure assets. They're constantly making mistakes. There's really very little documented procedure on these things. Let's see here. I just want to make sure. It looks like my audio is not working, so I'm going to just stop the sharing for 1 second and make sure. Can you guys hear my audio okay while I have the slideshow up? Okay, good deal. Just making sure. Let me go ahead and screen share one more time, and we'll get back on it. Okay. Now, here's the thing you got to understand. There are very few laws that govern the proper contractual procedure and disposal of foreclosure assets. What I mean by that is these banks, they put out these foreclosure addendums that basically say we can do whatever we want. We don't care what you say. We can still do whatever we want. Sign here, understanding that you can't sue us. You can't really do anything to us. We can do whatever we want. In a lot of cases, what will happen is if things don't go the way the bank wants, even though that you've shelled out the money for an appraisal, a home inspection, whatever, the addendum says that they can cancel the contract at any time. They're not required to sell you anything. Again, they can add additional cost as they want arbitrarily. So you have to make sure that you read all of the addendums that the bank provides you when you're buying these foreclosed assets. These banks will add some incredibly sketchy language in these addendums and contracts that basically take away any rights you have of doing anything in complaint and any sort of complaint. So keep that in mind. All right. The banks can essentially hold you ransom. And here's the thing. They don't have to give you back your earnest money. They don't have to. A lot of people don't realize that they don't have to. So just be careful what you wish for with those banks. And a lot of people ask, well, how specifically can they do that? And you got to understand these contracts are written by the banks or by their attorneys, either one, to absolve them of liability. You're waiving your rights to going after them for any liability. They can even cancel the contract and then sell the property to somebody else if they choose, and you have no recourse. So keep that in mind. Again, this comes back to these can be lucrative if you know what you're doing. Now, a lot of people say, well, I'll just sue them. And as I said earlier, you can try suing them all you want, but do you really think you're going to win a battle against the big banks? I don't think so. The banks are going to crush you. That's the reality of it. And myth number 2, I hear this one a lot. I can get a great deal buying at an auction. I had a guy the other day just sat there at a speaking engagement I was at, and he said, I won the auction. You did you? When you're an investor and you're buying a property for an investment and you're the highest bidder, and that means that you were willing to pay more than anybody else for the asset, does that always mean that you won? Think about that. Is the winner really the highest bidder? No, the bidder is the highest bidder is the person that's willing to spend the most amount of money. So don't think just because you won the auction that you actually won. The people that lost the auction, the people that you outbid, they are probably the winners. You got to think about why you're buying. Here's a couple things you got to think about with an auction. Buying at auctions usually, not always, but usually means that a cash purchase is required. Okay. Auction bidding is often emotional. What that means is it's really easy to overpay. You can lose sight of what's going on. You can not be paying attention to where the bids are. So be careful when you're bidding in auctions. If you're going to use a bid in auction, be very, very careful. Don't let your emotions overtake you. Many auctions require blind bidding. That means you can't see inside the house prior to bidding. Things you got to think about. And as I said a minute ago, is the highest bidder really the winner? Or are the losers of the auction really the winners? Buyer's premiums, better read the fine print. They can get out of control. People complain about a real estate commission at 6, 7, 8%. Buyer's premiums in a lot of cases start at 10%. That's a commission, guys, and you're going to pay that. Also, I'll understand that on a lot of these auction platforms, these online auction platforms, you've got some unscrupulous people that are going on there and bidding these things up artificially high. And then they're hoping that they can then, because there's so much activity and everybody wants these things, they're hoping that they can, if they win, they can add a couple $1,000s to that price and resell that contract to somebody else. Now, realistically, if they're the high bidder, that means everybody else was done bidding. Not to say it can't happen, but it's very unlikely. The success rate for this happening is very small. What you find a lot of times is it's usually wholesalers, and in some cases, I've seen real estate agents doing this. I've heard of real estate companies that endorse this. Now, I frankly think it's highly unethical. Don't bid unless you're actually going to close on the property. Same way of don't make an offer on a property that you have no ability to close on. Even if you're wholesaling, you should have a plan in place. You should be finding houses for buyers, not finding buyers for houses. Real estate agents find houses for buyers, or buyers for houses, rather. Myth number 3, paying cash is the best way to buy. I know people that stand there and they puff out their chest and they say, oh, goodness, I'm the man because I'm paying cash. Well, I don't really think so, because there's not a whole lot of expertise involved in paying cash, because you can always get the seller to say yes. If you keep throwing down $100 bills, eventually they're going to say yes. That's not negotiating, guys. That's buying yourself a yes. So think about that. Those of you that have cash and you're out there, feeling proud of yourself that you're able to pay cash, that's fine and dandy. I can pay cash too, but realistically, the chances of you overpaying for a property because you're paying cash are off the chain high, very, very high, very high risk for overpaying. Too often, I get phone calls from people saying, look, I paid cash for this property. I was going to leverage my equity. I figured I would pay cash now, and then I would borrow against the equity later. And they come to find out that the banks aren't wanting to loan on investment properties as often as they used to. Lending restrictions are getting a little tighter and tighter and tighter. Now, hopefully, if the president unwinds the Dodd-Frank Act, that may ease some of the lending restrictions. But it's anybody's guess whether or not he'll be successful in pulling that off. So I believe that paying cash being the best way to buy, I think that's flat out false. Number 1, your cash on cash return is significantly less as compared to using leverage. Okay. If you're using leverage, you're going to get a significantly higher cash on cash return, folks, because you're basing your return on, let's say if you have a $100,000 property and you only put $10,000 down on the property, now your return is based on $100,000, your appreciation, you're going to make a heck of a lot more money because your appreciation is not based on the money you put into the deal. It's based on the cost of the asset and the value of the asset. So you're much better off that way. You lose the mortgage interest deduction. If you're buying investment property, you should be entitled to take a mortgage interest deduction. Check with your CPA to be sure on that. If you're paying cash, you don't have that ability. That could be a powerful tool to help offset some of your tax liability. The number of value of the assets you could acquire is limited to the amount of cash you have. I have buyers right now, all they have in the world is $100,000. Well, guess what? They can buy one property if they pay cash. But if they use leverage, seller financing, creative acquisition, bank loans, they can buy plenty of properties. Why buy just one? And people say, well, I own it. It's mine. Well, big deal. Well, number one, if I trip and fall, I can sue you and take your property because there's no debt on it, right? So you're kind of an open target. One of the ways around that is land trust, and we'll talk about that on another episode here. But you're putting a big target on your back, owning it free and clear. Yeah, you'll make more rent, but realistically, your cash on cash return is diminished. So what sense does that make? Wouldn't you make more money having 10 rental properties versus one? I think so. Think about the $100,000. You use it on one house, or use the $100,000 as $10,000 down payments, buy 10 houses. Much more powerful strategy. You can get a lot more bang for your buck, guys. Okay. Myth number 4. Condos make good rental properties. You're never going to convince me that condos make good rental properties across the board. Here's why. Most condo associations have rental restrictions. And I know your real estate agent told you that a condo is a great investment. BS. If you're buying a rental property, and it's a condo, listen to these points that we're going to talk about here in the next few minutes. Okay. Rental restrictions means that the condo board, which is usually an untrained, inexperienced panel of regular people, get to decide who rents your property. You don't really have a say. They're going to decide whether or not your tenant is acceptable by their standards. Think about what that means. When you're dealing with non-sophisticated or inexperienced people, they have control over your investment by the decisions that they make. Is that a place you want to be? Do you want strangers, worse, non-sophisticated or inexperienced strangers, having control over your investment? If that's the case, guys, if you're okay with that, just buy stocks, because when you buy stocks, you've got some guy or girl on Wall Street wearing a $1,000 watch and some nice shoes out there trading your retirement plan. Why put yourself in that position? Does that make good sense? Well, that's one of the great American lies that I talk about. We're raised to believe that, we trust our government. We should trust Wall Street. We should trust everybody, right? Trust but verify? Condo fees, maintenance fees are often overlooked. I've had people tell me, well, that's just the cost of doing business. Well, you're right. It's the cost of doing business, but you have to factor that in when you do your due diligence. You have to take that and count that as your expenses. Now, let's say, for example, the condo board decides they want to resurface a swimming pool, or they're going to repave the parking lots. If they don't have enough money in reserves, it's highly likely they could put an assessment on all the properties in there, or a portion of them. And if that's the case, you could be looking at a bill for several thousands and sometimes into tens of thousands of dollars in assessments. And people say, well, they let me make payments. Yeah, they let you make payments. But if your cash flow is like $150 a month, let's say, and let's say the payments of that brandy new assessment is $100 a month, you just lost $100 a month in cash flow. And let's say if it takes 5 years to pay that off, but somewhere in the 5 years, you blow a hot water heater. Well, there goes the rest of your cash flow. Now you're upside down. Not very smart. Applications for tenants can take weeks to process, and they add extra cost on top of your independent research. And here's the thing, most likely the board members, they won't even share the results with you. It's either a pass or fail. So they may say, we're not going to take Betty Boop as your tenant. We're not going to allow her in here. And you're going to say, why? I pulled a credit check on her. She's fine. They don't have to give you a reason. They have no requirement to give you a reason at all. That's a problem because, again, you don't have control over your investment. And if you don't have control over your investment, you're going to have problems. Condo neighbors are more likely to complain about noise, toys outside, stuff like that in a condo. You know, if you're in a deed-restricted community, you're going to have the same thing here. I would avoid buying rental properties in a deed-restricted community because it's essentially the same as a condo. You risk a higher chance of people complaining. And some of these condos have the ability to fine the owner, to levy a fine against you. Let's say, for example, the one of the kids that lives at the condo you rent to someone keeps leaving their bike outside on the grass, and somebody complains, and you tell the tenant, hey man, you can't leave the bike out in the grass, and they decide to ignore you after 2-3 days. Well, the condo board can fine you $50, $100. Sometimes they can fine you daily, and you really have no control over it. I mean, you can keep telling the tenant no, but realistically they can just tell you to kind of pack sand. So think about that. You really don't have much control over that, and they can just send you a bill and you have to pay it. They can they can bill you daily. I mean, it can get ugly real quick. And if you don't pay that bill, they can come after you. In some cases, they can even foreclose on your condo and take it from you, subject to the debt. Myth number 5, foreclosures are always a great deal. I believe it's false. Here's the thing, guys, and this is going on in this market everywhere. I don't care if it's a foreclosure or not a foreclosure. Do not get caught up in a bidding war. Remember, we talked about auctions a minute ago. This is no different. Foreclosures often end up in a bidding war. It's kind of like a silent auction. I see this a lot in my market. You'll see a foreclosure sits in the market for 6 months, nothing happens, right? It goes on and off the market a couple times. There'll be like 4 months, no activity. It's just showing active in the MLS. All of a sudden, my client puts an offer in, and sure as heck, an hour later, I get a message from the agent saying, we're in multiple offers. Bring your highest and best. Really? We've had no activity on this listing for months, and now suddenly one other person or other people all decided they wanted to buy it in the same day? Come on. Sometimes the bottom feeders will, like I said earlier, will bid these foreclosures up, hoping to be able to assign the contract to you for more money in the hot market. If you're buying a foreclosure property, or if you're buying a property from a wholesaler, you should do a search on realtor.com and see if that property's in the MLS. Maybe call an agent, give them the address, have them pull it up in the MLS. I've had cases where people are taking properties off the MLS at full asking price, locking them up under contract, marking them up $5,000, and then trying to resell them to some unsuspecting newbie investor. Guys, that's not how you do business. That's not how you bring value to the marketplace. That's called being a bottom feeder. If you're a bottom feeder, eventually karma will get you. Karma's a bitch. Banks are often going to change the terms of the sale, like we talked about. Here's a big one. Foreclosures are often riddled with title issues. Okay. If you're going to buy foreclosures, you need to make sure that you have a title company on your team that is very good at doing what they do. You should always do a title search. You should always do a municipal lien search. These are critical things that you're going to need to do if you're going to be buying foreclosed assets. Frankly, if you're going to be buying any assets, you should be doing a title search, title exam, and a municipal lien search. Absolutely critical to make sure that you have adequate title insurance. If you don't do the searches, folks, you're not going to get title insurance. If you don't get title insurance and you find out there's some federal tax lien laying out there or some unpaid water bill, I got nothing for you. You're going to get stuck with that bill, and it's nobody's fault but your own. Bottom line, folks, is if you're out there as a wholesaler or a real estate agent, we get paid to bring value to the marketplace. Okay. Understand, we get paid to bring value to the marketplace. So in everything that you're doing, make sure that you are bringing value to the marketplace. If you're not doing that, or you're having a hard time making money as a wholesaler or a realtor, ask yourself, am I bringing value to the marketplace? Or am I just trying to get a deal? Don't be in a huge rush for the deal. The deal is just part of it, a very small part of it. Instead, focus on bringing value. And if you bring value to the marketplace, I assure you, the marketplace will return it to you. So keep that in mind. Now, at this point, if you have questions, you can use the question box right there. Let's see here. Yeah, Dave says on Facebook, he says auctions here are going over retail. You're absolutely right, Dave. They do go over retail on a regular basis. They're betting on appreciation. Guys, betting on appreciation right now, the way the economy is, you better rethink that line of thinking. That could get you in some hot water. Appreciation is fine, but you have to think about, is that really a smart thing to do right now? If you are a rehabber and you've got several projects that you've bought lately, several houses, and you haven't started construction on them, what are you waiting for? You better get cracking, because I'm telling you, this market's not going to last forever. You should be thinking about that. Now, people ask me a lot, why should I buy? Should I just wait till the market crashes? Well, first of all, trying to time the market is almost impossible. And when people try to time the market, they're usually wrong. Ask me how I know. And then when you're wrong, you're going to wind up, it's going to cost you money, or you're going to lose out. So don't get yourself in that trap. Instead, if you're buying for cash flow, really there's no bad time to buy, provided that the numbers make sense. Now, how do the numbers make sense? Well, you got to break down the numbers and make sure that you have enough income to cover the expenses, and that the cash flow number at the bottom is adequate. Questions in the chat. We've got Evelyn's asking, do you send comps to substantiate the offer? Comps showing rehab ones as well as non-rehab ones. Yes, I do. So if I'm going to make an offer that's low on the for a property, I educate the other party. Here's the problem that most investors and most real estate agents have, and this just happened last night. I got an offer over on one of my listings. The agent just emails it. Somehow in the last decade, it became okay for people to just send email out offers and not say a word. You might get an email saying, just confirming receipt. And then they wait. No phone call, no call me up and tell me the features, the benefits, nothing like that. It's not good business practice, guys. Here's the thing. You're an investor. Explain the offer to either the listing agent or to the seller. Have a conversation. And I know we exist in a society where everybody's a victim and everybody's non-confrontational and blah, blah, blah. Here's the deal. If you can't sell your offer, chances are it's not going to get accepted. Keep that in mind. I'm here to tell you, if you're unable to sell your offer, if you can't explain the features and benefits of your offer, then it's not going to probably get accepted. Because if the seller gets 5 offers, what do they have to choose from? They're going to look at the price. So if your price is not the highest one, remember what we talked about auctions, if your price is not the highest one, what are they going to do? They're going to call for highest and best. So then whoever pays the most amount of money for the property gets it. That's how you get into these auction-like environments. Don't do that. That said, if you want a discount for the property, justify it. Sell the idea of the discount. Don't just send over a lowball offer. You got a $100,000 house. Don't just send over a $50,000 offer saying, I'm an investor. Who gives a crap if you're an investor? That doesn't entitle you to a discount. If there's nothing wrong with the house and the seller doesn't have a compelling reason to discount it, nobody cares if you're an investor. And trust me, the realtors, they know you're broke. 99% of investors got no money. We know that. Okay. Same thing with real estate agents. 99% of real estate agents got no money, but for some reason they drive a Mercedes. I don't get it. When you make an offer, justify that offer. If you're offering below list or below asking, justify it. If it's through the MLS. If it's to a seller direct, make an offer that solves the seller's pain. You got to find out why they're selling. This is why I'm saying through the MLS, you cannot be direct to the seller. Not easily. You can be, but not easily. You're going to have to establish rapport with the listing agent. You're going to have to ask the listing agent that you be present when your offer be presented. Now, A lot of listing agents, they won't allow that. I don't understand why. Mainly because they're probably shy and they're unable to negotiate. Most real estate agents I know are not able to negotiate. They'll admit it. They can't negotiate. They thought being a real estate agent involved selling pretty houses. And then you give them an offer that's low, they start talking you back up again. That doesn't make sense. Your agent should present all offers. Yes. However, you should help educate your agent on how you got to those numbers. Or if you don't have an agent, you're dealing directly with the seller or the listing agent, educate them on how you got to those numbers. People fear what they don't understand. And if you don't take the time to educate them on the logic behind your math, then you're probably not going to be successful getting your offer accepted. This applies to investors and realtors. Either way, you have to justify it or explain it. You have to make sure that the offer solves the seller's problem. Okay. Guy's got a pretty house. He's a rock star lawyer, let's say, with a bustling practice and two and a half kids and a beautiful wife, and the guy cutting the grass out front, and it's a Sunday afternoon, and he's got no problems in life. Everything's grand. You go up and offer him half of, or 70 ARV minus 70% minus repairs. He's going to laugh you off his front yard. He's going to laugh you right off the front yard. But if the attorney is getting a divorce, or he's got some broken windows in that house, or he hasn't paid his property taxes for a while, or he just inherited the house, maybe there's a compelling reason that he might be willing to sell the property at a discount. Okay. Find out that reason, find out his pain, and write the offer that will solve the seller's pain. Okay. Hope that answered your question, Evelyn. Let's see. Lance asked, if you do find issues with title from an auction purchase that you won, what are your options from there? Well, option number one is you can write a check and fix the problem. Now, my title company, if you're buying in the state of Florida, my title company has a new program where he is the only one around that has the ability to insure the title on an auction property. If you want more information on how to do that, reach out to me and I can give you his contact information. That's only in the state of Florida. If you're in the state of Florida and you insist on buying from an auction and you want title insurance, he can set it up to where he can insure the title. And the way he's got it done, and I'm going to bring him on one of these episodes so he can explain it, because he can explain it better than I do. But you basically pay for a title search up front. So you designate a house, you pay for a title search. It's cheap. It's like under $200, let's say. Title search, municipal lien search. As long as it comes back clean and you win the auction, they can then insure the title. When you buy that title insurance policy, you have the ability to, then say you're going to sell the property later, they can issue a reissue credit to the new buyer, which winds up giving you a significant discount on the second policy. And in some cases, it winds up being free is basically how it works out. It winds up being free. So you get free title insurance, or almost free, which is amazing. But Kevin's kind of a really smart guy, which is why he's in my title company. So if you're interested in that, go to my website, cashflowguys.com. Send me a message. I'll send you over to Kevin. It's Kevin at Insured Title, and he'll get you squared away. Again, that only applies in the state of Florida, this program. He only insures title in the state of Florida. So if your property's in the state of Florida and you need title insurance, reach out to him. He'll give you a great price. Taylor, when you hear highest and best, you lower your bid by $50. Yeah, exactly. Highest and best. And I'll be honest, I do the same thing as a listing agent. I get multiple offers. Hell yeah, highest and best. It's my job to make sure that I get the seller what they need for the property. In a lot of cases, that's top dollar, but not in every case. Understand that. People ask, well, how do you wholesale as an agent? Well, here's the deal. I find out what the seller's needs are. And if the seller needs to sell that property in a hurry, they need it done in 10, 15 days, then maybe the MLS isn't a good option. So what we'll do is we'll come up with a price that I'm pretty confident one of my buyers will pull the trigger and buy the property and buy it quickly. And we'll draft a contract, have the seller sign it, I'll reach out to one of those buyers, have them sign it, and then I simply have a listing agreement in place because I'm a licensed agent that covers my fee. So you see, I don't have to jump through all the silly hoops that most wholesalers do because I'm not the way I do things. So if you're an agent and you're not focused on the needs of your seller, rethink that a little bit, because the needs of your seller don't always mean getting them the highest price. In a lot of cases, they need this house gone now. And if that's the case, you should be in a position to facilitate that. Too often, I hear agents throwing properties out on the MLS at a price higher than what the seller has asked. What that does is results in a longer market time. So you're not representing the needs of your seller. That's not what they asked for. I've had sellers tell me after a property was expired, I only wanted 150. And the agent told me I should put it on the market at 179.9. And then it didn't sell. And now I'm behind on my mortgage. That goes on all the time. So, questions, guys, at this time? Lance, I hope that answered your question. All right, guys. If you don't have any more questions, I guess we'll wrap it up there. If you do have a question, go ahead and type it in the Q&A section, and we'll get it answered for you. Hope you guys found this useful. For those of you that don't know, if you haven't heard it already, the Larry Harbolt's Never Step Into a Bank boot camp is coming up next week. Starts on the 16th, runs through the 19th. That's Thursday through Sunday. It's a game changer, guys. If you don't know how, if you have not ever negotiated seller financing terms or taken a property creatively, if you're looking to learn how to buy property without having to use your own cash or very little of your own cash, then you need to get on board with this course. Now, it's being held in Tampa, Florida, Terry. It's being held in Tampa, Florida next week. But if you can't make it to Tampa, Florida, we're considering offering a live streaming option. If you're interested in a live streaming auction, I can put the link right here in the box. Give me 1 second, and that you can come on via live stream. Give me 1 minute. So make sure I got the right link, because I'm old and I forget things. So the event is in Tampa, Josh. On your email confirmation, it will have the address of the hotel. And then we're going to be sending over your materials probably on Monday. There we go. Live streaming option is available, as I said. That's for people that are unable to travel. Here's the thing, though. The live streaming, it's great. I mean, you'll be right there. It's like you're being a fly on the wall. But what you are going to miss is the networking. And the networking is really, really, really powerful. You're going to meet a lot of experienced investors, because Larry offers that once you come to his course, if you've paid for the full version, once you come to his course, you can repeat it over and over and over again as much as you want for free. That's a very powerful benefit. And a lot of experienced investors take advantage of that. I go to it every time it's being offered, because I learn something new every time I go. And I meet new people every time I go. I've met several of my investors there that have become private money investors with me, that they come to that course to up their game a little bit, to learn more about what's going on. It's worth it for them. And I've picked up several investors in private capital at that event. So it's a real good time. And, you're going to get, yes, Victor, I see your questions. Give me 1 minute. And you're going to have the opportunity to network with Larry. You're going to have 8 hours a day of Larry, breakfast, lunch, and if you want it, dinner. Over and above that, we're going to do a bonus session of the Cash Flow 101 game. It's the game that I use to educate people on real estate investing but it's also a tool that I use to raise private capital. It is a great way to raise private capital. So we're going to be talking about raising money. That's going to be a special bonus breakout section. Unfortunately, that will not be available via live stream because of the complexity of setting all that up with the moving parts and the people and the whole 9 yards. But that will be coming up. So let's see here. A couple more questions have popped up. Victor, what can be done to avoid getting hurt during another 08? It's very simple, Victor. Don't sell when things go down. Now, in 08, everybody panicked. Oh my God, the market's falling. I better sell. What goes down will always come back up. Okay. Just like the stock market. People lose money in the stock market because they buy a stock when it's here and they sell it when it starts to tank. That doesn't make sense. If you buy today for, say, $100,000, and let's say another 08 happens and your $100,000 house is worth 50. Well, here's the news. Don't do anything. Okay. Don't do anything. Because if you're smart, you're buying for cash flow, not for appreciation. So as long as the property pays for itself, in other words, you have a tenant in place and the tenant's paying all the bills and there's some profit left over, and you have a fixed rate mortgage, that's the key. Do not sign on an adjustable rate mortgage. Don't sign for balloon payments, guys. Balloon payments are the death knell for investors. Don't sign them. I would maybe consider one on a multifamily commercial property over 10 doors because I know that I can control the value. Market shifts are not going to affect me if I've got big assets or bigger assets. That's how I play. But if you're buying single family houses, guys, do not get on board with an adjustable rate mortgage. Do not agree to balloon payments. If the seller wants their money in 10 years, tell them they can sell the note. That's how that works. So just don't get caught up in buying deals with bad financing. Don't step into somebody else's quicksand. Larry Harbolt says that. He'll beat that into your head if you come to the seller financing boot camp. Don't buy bad deals. And people say, well, how do I get a good deal? Well, you're going to learn how to negotiate. That's part of why I'm doing what I'm doing, because more people need to learn how to negotiate to be effective. So if you're buying for cash flow, Victor, it's impossible for you to get hurt. As long as you don't sell when the market goes down, just wait it out. If the tenant's paying the rent every month, then you should be making a profit over and above paying all the bills, paying the mortgage. You have no reason to sell. None. So just simply move on, move past it. Okay. Don't sell when it's down. And that will help you make sure that you don't lose money. So there is no bad time to buy because great deals can be negotiated no matter what the market's doing. I can tell you, because we're still putting together great deals for our investors on a regular basis, even though the market's hot. But that's part of the reason why people hire me as their agent, is they know I can negotiate. That's what I do. That's how I earn my fee. So don't make those mistakes. You will not get hurt in the crash when it comes. Number two is with multifamily. I just want to throw this out there. With multifamily assets, the value is tied to the income that the property generates. It's not tied so much to comparable sales. Comparable sales is what single family homes are tied to. So as long as you're buying an asset that the value is derived from the income, in a down market, your income should go up because a lot of people are bailing out on their houses. They need a place to live. There's already a shortage of rental property in the marketplace. When there's a shortage, that drives the rents up. It's supply and demand. So think about that. John Williams in Charlotte asked, I'm having a hard time getting a seller's agent to tell me what their client's problem really is. They don't want to say. That's right. They don't. So here's how you fix it. Stay away from listed properties. The agents have a fiduciary responsibility to their client. Okay. What that means is in most cases, they have what they call confidentiality. They're required to either remain confidentiality or limited confidentiality, depending on their arrangement with their seller. So you're probably not going to be successful in getting to the seller's real pain unless the agent has some compelling reason to let you know. However, the agent technically can't stop you from being present when the offer is being submitted. And for more information on that, go to the NAR, which is the National Association of Realtors Code of Ethics. In the Code of Ethics, it clearly says in there that the Buyer has a right to be present when their offer is being presented. Agent can't refuse that. Keep in mind, you kick sand in that listing agent's face, they don't like being pushed around. So if you use that theory and you push the code of ethics on them, you better be careful how you do it, because they'll fight back unless they're weak, and then they'll just roll over and let you do it. But they won't be on your side, I can assure you that. So, John, avoid properties that are listed by an agent, and you can avoid that problem. I'm telling you now, and I've told you this before, if you focus on bigger assets, this problem will be reduced, because commercial agents are far more likely to share this information with you. They're not held to the same brokerage relationships in a lot of cases as a residential agent is. So they're going to show you income numbers and things like this. So a lot of times you can use the information they're required to provide you based on the terms of the offer. For example, if you ask for due diligence, you can, what I call where's Waldo, you can find Waldo simply and find their compelling need to sell if it's financial, just by going through the due diligence process. So get it under contract, and if you have to, renegotiate. So think about that. I'm going to put that link. Let's see here. A couple people are asking for that link in the chat. So that solves that. Evelyn asked, do you use Realist to find sellers with equity? Yes, I do, and I will show you, Evelyn, how to do that a little bit later, because that's not something most of the people on this call don't have access to Realist. That's a software program that's essentially for real estate agents and those who have access to the MLS. So there you have it. Victor, yesterday I told you not to ask about double closing when calling the title companies. You're absolutely right, I did. Double closing with most title companies is taboo. Double closing with most real estate attorneys is considered taboo. You don't need to double close, okay? You're never going to be able to convince me a reason why you need to double close. You're getting bad information, and it wasn't fully explained to you the proper way. I'm working on making the steps to get that corrected. Unfortunately, I only have so much control over what you get access to, but that is not accurate information. You do not need to call them and ask about double closing, because you don't really need to double close. For those of you that want to know what double closing means, basically you're in a double close, you've got an A to B transaction and a B to C. Routinely, wholesalers and some gurus teach this as a way for you as a wholesaler to hide how much you're making, or hide who the end buyer is, or hide who the seller is, which means I don't believe it's a good way of doing business, because if you have to hide, what are you up to? Why do you got to hide? I mean, really, if you can't do honest business and if you can't justify your fee based on the value you bring to the marketplace, then you need not be doing business in the marketplace. That's the majority of the time. That's why wholesalers are using double close, is because they're trying to hide their fee. What are you hiding from? What are you embarrassed by? What's the big deal? Be upfront. Here's my other issue with double closing. If it's not done to the letter, 99% of the time, title insurance cannot be issued to the end user. Or if it's issued to the end user, there are exceptions on the title insurance policy that prevent certain parts of the title transfer procedure from being covered. That is high risk. So you're putting a buyer in harm's way. Now people say, well, I don't care, I'm just a wholesaler. Well, and that's my point. See, a real estate agent has in their licensing, which is pretty much all they teach them, is how to protect their client and how to protect themselves. Wholesalers, you're not taught that. You're taught how to install bandit signs and make money asking for double closes and things like that. Not trying to be cocky, I've wholesaled as well, but I'm always looking out for my buyer, because I believe I have an ethical responsibility to make sure that my buyer is well protected. And over and above that, I'm held to that ethical standard by the fact that I carry a license in the state of Florida, okay? I'm not going to let my buyer close without title insurance, period. And I'm not going to let them close without title insurance free of any exceptions, okay? They're going to get bulletproof title insurance or they're not closing, because I don't need the check at the end of the closing, okay? I have passive income, so I'm not out there uh, just trying to flip property so I can eat and not worried about other people. I am concerned about my buyer and their well-being. If I'm representing the seller, I'm concerned about their well-being. So you don't need to worry about double closing. You just don't. And I don't, and other people will tell you different, but I'm here to tell you, you don't have to worry about double closing. I hope that helps. Just ignore that advice. Candace, hard copies of the course materials, that's an upgrade that you were offered at the time of checkout. If you want the books and the physical CDs, the hard copy materials are available for an additional $300 as an upgrade. So if you want those, let me know. I can send you the link to get those, and that will help you out there. Evelyn, yep, we can discuss later today when we meet. That's fine. We'll talk about that. Good morning, Aaron, out in Dallas, Texas. How are you today? Aaron, do I send a cover letter and or a credibility packet when I send an offer to the seller? Honestly, no. And the reason being is I'm always face-to-face or this type of medium, Zoom or something like that with the sellers. When we put an offer together, it meets the seller's needs. It solves their pain. I buy distressed assets. When we buy an apartment building, it's got issues. I'm solving their problem. The question of whether or not I can close, honestly, has never come up. And I feel I do a good job of focusing on the seller's needs and providing a solution to it. So my credibility has never been questioned at an offer, and I own a ton of property. That's me. I found that a lot of credibility kits aren't worth the paper they're written on. I've had credibility kits sent over to me, and the minute I start to verify them, I'm finding all kinds of holes in them. So I will say, make sure whatever you do send over is 100% accurate, because most credibility kits I've run across are not. It's kind of like giving references. Whoever gives somebody that's going to give a bad reference. You only give the names of people that will give you a good reference. Therefore, asking for references is kind of pointless, in my opinion. I doubt that you're going to put somebody on your resume that's going to say, that guy's a dirtbag. Oh my God, he was drunk and he ran naked through work and he was assaulting people and he peed on things and it was terrible. Oh my God. So no, I don't feel the need for him, but not a bad idea if you're just starting out and you're brand new and you're asking for terms, maybe, then the seller does ask for one. Never hurts to have one in your back pocket. I have one prepared, yes, but I'm very concerned and focused on my liability. So I'm not going to share with the world what all my assets are unless I'm required to, because I believe that makes me a target, because there's lots of crazy people out there. I've been the victim of a cyber stalker. I'm not going to expose my assets and where my money is and where my assets are to anybody for any reason, unless it's absolutely critical. And those people are going to sign a bulletproof non-disclosure agreement. And if they disclose, I'll go after them with both guns. That's me. So I hope that helps. Sorry for the late question here. Just thought of it. You mentioned in the podcast that you purchased a property recently where the seller wanted 100. You offered 120 with seller financing, where the seller could then sell the note. How would I be able to sell the seller on taking a note? How liquid could that be, and how could they sell it? Well, it's very liquid. B2S15, I guess is what your name is. First of all, how do you sell it to the seller? Well, you got to address the seller's needs. And I know I say that a lot, but the offer, first of all, needs to address the seller's needs. Forget about how you can get the money to them. We got to get the terms in place. The value that they're going to receive has to be agreed upon. And then how they pay, or how you pay them, is kind of like the one of the last steps. So in that case, the seller has a note worth 120. Right? It's written at 120, which means I'm going to make payments based on 120,000. If the seller sells that note, I've told the seller that I agree to give him I'm intending to give him a net of 100. Okay. And the reason why I wrote it at 120 is that he can take that $120,000 face value note. He can sell it for $100,000 cash if he needed to and go on about his business. I do that as an incentive to the seller. Because if I gave him a $100,000 note and he sold it at a discount, he would probably get less than $100,000. And then he probably would not agree to that. So when the seller really needs their 100,000 and they're not going to budge, I will overvalue the note so that there is an ability for the seller to discount the note when they sell it to another party. And then whoever they sell the note to, that's who I'll make my payments to. That's basically how it works. How liquid can it be? Very liquid. You can give them several notes. You could give them five $20,000 notes, and they could only sell one or two of those notes for some liquid cash, and they could hang on to the rest of the notes so they can have that predictable stream of income. I've never really ran into anybody who didn't like the idea of receiving money in their mailbox every month. Nobody's ever said, "Ooh, no, I don't want money." Ooh. So it's a very powerful strategy. I learned that from both Larry Harbolt and Peter Fortunato. That's a trick that they use, and it works very, very well. Candace says, when do you walk away after assigning your contract in a wholesale transaction, or should you remain involved to see it through to close? Is there such a thing as too much involvement? I think there is such a thing as too much involvement. I mean, you could wind up driving everybody crazy. That I've heard of that happening. And I know this is going to make people tweak when I say this, but here's the reality. You are technically, in my opinion, you're doing the same job as a real estate agent to some degree when you're a wholesaler. That's just the reality of it. Don't tell anybody I said that, except for the 26 of you on this call and everybody that's watching the replay. Ha. But when you're bringing the buyer and the seller together in that relationship, you kind of got to make sure that it gets to the closing table if you're going to get paid. Now, a lot of people I've seen lately are taking earnest money deposits from the buyer themselves before closing. If you asked me for an earnest money deposit that I knew was going in your pocket, I'm going to scream scam. The earnest money for a deal should go to the title company, because then it falls under it's protected based on state law. Okay. The minute you as a wholesaler takes that money and puts it in your pocket, you created problems. Because if the deal falls apart, number one, you're going to have to write a check back. And most wholesalers I know are broke, and they're not able to write that check back because they've already spent that money. You should get paid when the deal gets done. Your job is to transfer the deed from the seller to the buyer. So your job is not done until that happens. Therefore, I don't believe you should be paid until that happens. I don't collect my money until the deal's done. I don't believe I have a right to the money before the deal's done. That's me. So, you can do it either way you want, but I think you should be involved, because as a wholesaler, it's your job. One of the ways you're bringing value to the marketplace is to make sure this thing gets to the closing table and to solve problems. That's what you're doing as a wholesaler, is you're a problem solver. So you have to be involved to be a problem solver. There you go. Jim asks, how would you structure a duplex deal in an area where the taxes and monthly expenses are high? Or would you just avoid it? It's a major rental area, but seems like not much cash flow even when buying at a low price. Is there a strategy since price isn't always important? Yeah, the first thing I would do is look at the expenses. For example, I was underwriting a mobile home park a few weeks ago. I was vetting this deal for one of my coaching students. I was helping them through the process, and we discovered that the owners had been sticking their medical insurance on the LLC on the expenses of the mobile home park. And they had a big family. They had like 8 kids. And these kids were all adults. So they had all these full-blown insurance policies tied into like a group plan tied into this mobile home park. So it was crazy. And they just put it under the insurance. They didn't even say medical insurance. They said insurance, like it was property insurance or casualty insurance. So when I looked at the insurance number, and I don't know what it should cost for insurance on a trailer park, because it all varies depending on where it is, how many pads, whatever. So I called my insurance guy, and he looked it up. He's like, no, man, that's not even close. That's about double what it should be. Oh, well, I bet you that other people that were looking at that same deal didn't bother to do that to see if there was some, what I call found appreciation there. In other words, by simply buying the asset, there could be a ton of profit hidden right there. That said, I will use the fact that the expenses are out of line to negotiate the price down further. I'll use that as a means to get the price down. So that's one strategy, is working on those expenses, figuring out, are these expenses accurate? When you say high, what's high? And what, as far as the taxes, you're not going to get out of the way of taxes. In most cases, there are ways you can mitigate property tax, but it's usually only for a short period of time, not forever. So monthly expenses, you can't not calculate them. So make sure they're accurate. Sometimes people put things by mistake as monthly expenses that are actually annual expenses. For example, I had one recently where they said the electricity was $4,000. Like, that's interesting. $4,000 for electricity. It was like a 10-unit building. And it was as a monthly expense. I'm like, $4,000 a month for electricity? What are they doing? Powering a small city? So I looked into it and found out that what they meant was annually, $4,000 a year, but they put it in the monthly column. That's part of the due diligence process, is to verify that. As far as price not being important, that's absolutely true, provided the terms make up the difference. In other words, I'll give you $1 million. I say this a lot. I'll give you $1 million for a property if I can give you $200 a month until paid. So if the numbers don't make sense, then that's a prime candidate for seller financing terms. Prime candidate for seller financing terms. Because the seller is going to have to take his equity payments over time, because banks aren't going to loan money on it. Nobody pays cash for rental property, guys. Just, you got to get this in your head. Mindset. Okay. Mindset. And I know somebody right now is going, yes, they do. Yes, they do. Yes, they do. Convince yourself that they don't. Believe that people don't believe that there are people in this country that are not dumb enough to pay cash for real estate. Convince yourself of that fact, that there are people in the world that are not dumb enough to pay cash. Once you believe that, it becomes a mindset. And it becomes a mindset when you're negotiating terms, you're going to be convincing, because you truly believe that nobody would be dumb enough to pay cash for an apartment building. That wouldn't make sense. And when you believe it, everybody else around you will start to believe it. See, some of you are believing it right now, because I truly believe it. Every time somebody puffs their chest out and says, I'm a cash buyer, I think to myself, you're a moron. So think about that. Hope that answers your question. Yeah, let's see. Looking at duplexes, Jim, Parma, Ohio, and even at a low price, it seems that water, sewer cost, taxes, maintenance is tougher to clear a profit. Then the only thing that you can adjust is price or terms, Jim. If the expenses are accurate, then that means the price has to come down. And that's not your fault. That's just the reality. And I understand they want $200,000 for their duplex that rents for $600 a month, but they ain't going to get it. And when you just are good at explaining to them and showing them where they are losing money every month at that price, hey, Mr. Seller, I can give you the $200,000 for your duplex that makes $1,200 a month, but here's the problem. If I do that, I'm losing $1,000 a month every month. So why would I buy this property and lose money at $1,000 a month? And he'll say, well, that's because you're factoring a mortgage. Well, yeah, nobody pays cash for property. You know that as well as I do, sir. You're an experienced investor. You know better than to pay cash for a property. And see what they say. And they'll usually go, yeah, I know better. Okay, well, then we're not going to talk about that anymore. What else you got? You don't say it that way, but realistically, that's the logic that you're putting out to them, and you start shaking your head, right? You know better than that, right? Nobody, you shake your head. Nobody pays cash for property. Well, this guy called. Oh, come on. Nobody does that. Where is that guy? Where is he with this suitcase of money? Nobody does that. Come on. Come on. And he'll start agreeing with it. Yeah. Okay. Richest man in Babylon. What are the benefits of getting a real estate license? Well, for me, I make a killing off of referral fees. Number one, you can make really good money off of referral fees. As far as getting otherwise, you know, when I go into a situation, I have a reputation in my town as being a problem solver. So people call me with problems that result in real estate all the time. And no matter what the scenario is, I can come up with a solution because I'm licensed to do so. So I can walk in there with my investor hat on and decide that this is a deal that I don't want. Doesn't fit my criteria. But Mr. Seller, I can sell it for you. And I can do that by simply putting it on the MLS, or I've got other buyers that I could sell it to. And I don't have to jump through a bunch of hoops trying to wholesale it or double, triple, quadruple close it or whatever else you can come up with. I can simply put it on the MLS and sell it and get the guy top dollar for it and then make a very handsome commission that I control for doing so. So thumbs up. So there you have it. Candace and Shireen, let's see. Yeah, I'll send that link out to those of you that registered for the materials tonight. The link, you can only buy it if you've registered for the course at the $300. If you want to just buy the materials and you have not registered for the full course, it's $14.97 for all the materials. That's his fee. So only if you've registered for the course do you get the hard copy materials for $300. That's the policy. Because the gold is the materials are amazing. Richest Man in Babylon says, can you refinance an investment property now almost right away? You say mindset so much now that I finally understand the importance of what you're saying. Yeah. So that is a myth. It's becoming a myth, I should say. It used to be that you could buy a property cash and you could refinance it the next day. And what I'm finding these days, and I talk to a lot of lenders, a lot of mortgage brokers, a lot of banks, it's becoming increasingly difficult to do that, to as an investor, to pull your money back out. So the first part of that is I want to ask a question with a question. Are you bankable? Because you have to think about, are you bankable? In other words, if you just assume that you'll be able, of course I'll be able to pull the money out, right? I only want 50% of ARV, let's say. Well, if you're not bankable, i.e. if you're self-employed or you may have some credit issues, they may not loan you your equity. And I know a lot of people that go pay cash to find out that they can't get their equity back out. So think about that. Be careful. The first step would be to find out from your banker or from your mortgage broker. I'm a believer in mortgage brokers, frankly, because mortgage brokers have lots of solutions. I want to find out, can I pull equity out of this now? Or if not, when? And what needs to happen for that to happen? And how much equity can I pull out? And how much is that going to cost me? Okay. I know people that put their last dollar into a rental property because they had to pay cash because I could get a better deal. And then they find out they can only borrow 20 grand and the 20 grand comes out as hard money. You haven't done your due diligence up front. So reach out to a lender and make sure that you can do that. Or if you're going to use private money to leverage that equity, identify that private money partner and have a conversation with them. Hey, Tim, I'm going to buy 123 Anywhere Street. And when I'm going to pay cash for it, but when I do, I'm wondering if you would like to invest your money into that deal. And they'll say, maybe, yes, no, whatever. What are you going to do with it? Well, I'm going to keep it as a rental property, but if you want a place to park, I'd like to get some of my cash back out so I can do another deal. If you would like to park some of your money in that rental property, I could probably pay you a good return, or we can maybe make some sort of arrangement that would make sense for you. Maybe I could help you reduce your taxes and bring you in as a partner on the deal. Would it make sense to sit down and talk about that and just have a conversation like that? When you do that, have that conversation, come up with some sort of an agreement that makes sense, okay? That's based on their needs, not yours, okay? Because if you're not looking out for the needs of your investor, you're wasting your time. If it's all about me, you won't get very far. I have people call me on a regular basis going, Tyler, will you invest in my deal? I might, sure. Tell me about it. Well, I can't tell you about it. I need to know how much you're going to charge me. What do you mean, how much am I going to charge you? Well, how much is it going to cost for you to invest in my deal? Hell, I don't know. I don't even know what your deal is. Don't be that guy. Nobody likes that guy. But finding private money isn't rocket science. However, once you have that conversation with the private money partner, the next step would be is to get your attorney on the phone. The private money partner probably has an attorney. If they don't, they should get one. And you have your attorney and their attorney have a conversation as to structure. And if there's questions regarding taxation, you should have a CPA And if you don't have a CPA, you have no business taking on private money. Because if you're one of those morons that's doing your own taxes and you're borrowing money from somebody else, what happens if you make a mistake? Oh, I won't make a mistake. I read a book about it. What happens if you make a mistake? The IRS seizes your assets because you were filing the 1040 EZ on TurboTax because you're too cheap to pay a CPA. That they don't really charge that much, guys, because you're too cheap to hire a CPA to do it for you. I digress. You have your attorneys have a conversation with their attorneys to work out the legalese, right? And then your tax professional has a conversation with their tax professional so that everything you two, who are not experts, talked about regarding taxation and law makes sense with those who represent you. That's how you do it right. If you don't do it right, then there you go. How do you vet a CPA? Well, we're a little bit over time, so I'm going to give you a quickie answer on that. Basically, your CPA should be asking you more questions and should be being a pig, really. They should be asking you questions instead of telling you how wonderful they are. It should be 70-30 or 80-20 of them asking you lots of questions about how you do things. If you want a great book, 2 great books on the subject. This is a great book on how to find a good CPA. It's written by Tom Wheelwright, Tax-Free Wealth. Great book. This one, I interviewed the host or the author of this book. Real estate's a team sport. I don't know why I just went on some sort of weird background thing. That's kind of strange. Anyway, and then this one, what your CPA isn't telling you. And that's written by Mark Kohler. Mark Kohler happens to be my CPA, or he's actually the lead CPA. One of the other guys does my taxes, but this is a great book. It's written in story format. It's awesome on audio because he actually narrates it. And I love it when the author narrates it, unless, they sound like a dead fish, but he's entertaining. So that's a great book. And that will help you pick one. The second book, Chabelle, was Real Estate is a Team Sport by John Carney. And for the life of me, I don't know why it's pixelating like that, but on my end, it looks like it's pixelating. Real Estate is a Team Sport by John Carney. If you look at my podcast episodes, you will see that I had him on my show. Great guy. Lots of good information. So enjoy. All right, guys, you have a great day. Enjoy your Friday. Get out there and make some cash flow. I hope today we helped you learn to earn a little bit, and you will join us next time. If you are watching on Facebook, make sure you register for this at cashflowguys.com/coffee. That gives you access to all of the recorded previous episodes. I've done about 6 episodes so far. So that will give you access to that information. Lots of good information, lots of great questions from the audience. Those of you that were listening today and asked the questions, I appreciate you asking the questions. I hope you found the answers helpful. And if you register and you want to get access to my email list, if we're going to be doing some mini courses via email, go to my website, cashflowguys.com, and register. I will be sending out some mini courses to help you guys learn different topics. One of them will be finding a good CPA. How to find private money. I'm going to cover that via an email course. That'll be free of charge. But if you're not registered, you can't get the course. So thank you, folks, and you have a great day, and we appreciate you coming out. Talk to you later.